every bull market, there are three different stages. The first one is the accumulation phase, where the price is going down or sideways, where sentiment is really negative, and where only like die-hard contrarians start buying. So this is the moment when you go to a cocktail party and say, I'm buying this and that, people will start ridiculing you. Mm-hmm. Then the second stage is the public participation phase, which is the broadest and the longest phase, which is, the media is picking up on a topic. There are new investment products. The big banks, they raise their forecasts, and it's just going steadily upwards with small corrections, but they are being bought because there's lots of money on the sidelines. And then there's obviously the distribution phase, where those contrarian players that started very early, they start selling, where everybody goes nuts, where you see crazy market forecasts and analysts rising their price targets to ridiculous levels. New products, everything is using huge amounts of leverage. So that's like the third stage. I would say we're like somewhere in the beginning, or let's say the middle of this accumulation phase.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Today's guest is best known for publishing the world's most respected annual analysis of the precious metals market, known as the In Gold We Trust report. It covers what's driving supply and demand, the performance of the metals versus the companies that mine them, and what the outlook for prices is. This year's report, subtitled The New Gold Playbook, was just issued last week, all 400 plus pages of it. To learn its highlights, we're fortunate to speak today with one of its co-authors, Ronald-Peter Stöferle, managing partner and fund manager at Incrementum AG. Ronnie, thanks so much for joining us today, all the way from Liechtenstein.
Hi, Adam. It's actually the very first time on the show, and I really look forward to our conversation. Thanks for having me.
Well, look, it's a double privilege for me. One, being your first time on the show, and you've been a guest I've wanted to have for a long time. But also, you just informed me right before we turned the camera on that this is your first big interview post-release of your massive 400-page tome, which is just a great honor. And I know that you've got a huge gauntlet of media lined up here, but the fact that you're starting with Thoughtful Money is an honor, frankly, I don't deserve. So thank you.
You're most welcome.
Okay. All right, Ronnie, lots of questions to ask you, which I know I'm just going to be scratching the surface of this massive analysis that you've just done. So I'm going to look to you to really surface the biggest diamonds that are hidden within it. I do want to preface all this by saying that, in addition to being a tremendous expert on the precious metals, you are a fund manager. And as I say often on this channel, I put a lot more weight on people like you who manage client capital, because you don't have the luxury of just having an opinion, right? There are lots of newsletter writers out there who can, put in these wild predictions. Hey, gold's going to $10,000 an ounce tomorrow, whatever you want to say. And if it doesn't happen, there's really not that much skin they have in the game. But as a capital manager, you have to allocate client money based upon your convictions, and then be held, responsible for your track record. So I place a lot more weight on gentlemen like you. So with that being said, let's kick things off here. General question to start. It's a twist on my normal kickoff question, which is, after doing all this work, Ronnie, what is your current assessment of the precious metals market?
Well, actually, after researching, thinking, writing for so many weeks and months about the topic of gold, and actually, it's not about gold, it's about everything else. Gold is just there, yeah, but everything around is moving all the time. Geopolitics, interest rates, opportunity costs. It's not easy to just come up with a very concise reply to your general question, but I would say it's bull market. We are in a bull market. We've seen this massive breakout after flirting with the old all-time highs and the 2000 US dollar level for quite a while, and I compared it to the previous big bull market when gold took a couple of attempts to rise above the 1,000 US dollar resistance. So we've tested that 3 or 4 times, and then actually a very impulsive move started from $1,000 up to 1,900 in summer 2011. And I think that this flirt with the 2000 level and the all-time highs, it basically took us 4 years, and now we're finally there. And lots of momentum kicking in with CTAs and momentum driven players piling into this trade, and obviously, and that's one of the core topics of this year's report. The center of the gold world isn't in the Western world anymore. It's in emerging markets. That's something that we've been talking about for quite a while. And the interesting thing is that even though we've seen new all-time highs and a really, really big move, Western financial investors still couldn't care less about gold. And I think at some point they will join the party, but so far they haven't really joined the party, and that makes me pretty confident going forward.
So let me ask you this then. So Wall Street itself, just operating under status quo, loves momentum, right? If it sees price action moving definitively in a direction, it generally wants to join in the party, right? So you can make an argument that at some point, if the current momentum continues, you're going to have a lot of just institutional Wall Street capital say, hey, price is moving here, I want to be on that train. And then we get sort of a virtuous cycle from that. I also imagine from your comment there about the center of the gold market now being in the emerging markets and the West just really not caring that much about it, that there may also be an optionality here with gold where the West wakes up and says, whoa, wait a minute, we've kind of been asleep at the wheel here. And, maybe both for investing reasons, but also just maybe just for, kind of resiliency reasons, national security reasons, monetary reasons, we want to try to claw some of that back here. So am I correct in sort of looking at this, that there's sort of twin barrels here of opportunity that may fire at some point in the future?
Yes. I mean, we should perhaps differentiate between, let's say private demand from private investors, then obviously institutional demand, and then central bank demand. When it comes to all three of them, actually, emerging markets and particularly Asia are, driving this market. So actually, one of the key takeaways of this year's report is that the marginal gold buyer isn't in the Western world anymore, but rather in emerging markets. So, just a couple of numbers. When it comes to physical demand, China, India, and the Middle East are responsible for roughly 70% of all physical demand.
Right. Sorry, 70,
and that's
70?
that's 70, yeah.
70, okay.
So yeah, and I think that's I'm traveling quite a lot. I've just in November I was in Dubai, did a big presentation there, and I held a seminar for traders and large institutional investors, and for them topics like de-dollarization, that's just normal. While if you talk about that in the Western world, that's kind of a conspiracy thing. For them, it's pretty obvious that it's going to happen at some point, and then it's actually already happening. We've got one chapter about the gold market and the whole gold infrastructure in the United Arab Emirates. I think most people don't know that actually Dubai is responsible for 25% of the world's volume of gold trading. 25%, just Dubai. And if you add in the Chinese market, which has been going nuts over the last couple of weeks. If you add in India and some smaller markets like Vietnam, for example, but also Thailand, and most recently Japan. Just have a look at the gold price in Japanese yen terms. I mean, that's like the perfect chart. I think that's really important for many people in financial markets that are very much Wall Street centric, and perhaps London and Zurich and Frankfurt, but that's basically it. Um, I think it's really important to understand that the center of the gold world has moved to the east. So that's important. To come back to your question, if that's an opportunity for Western investors, I think it's in the US. You've seen, for example, with Costco and I think also Walmart starting to sell physical gold and also silver. That has become a topic, but it's that's another interesting chapter in the report where we ask the question if gold actually has some sort of a marketing problem or an image problem in the Western world. Because if you buy physical gold, you're often being regarded as a sort of a nutcase and like, you know, the prepper and of course Trump supporters and people that hope for a civil war and hyperinflation, whatever. So actually, you know, physical gold investments in the Western world are increasingly being regarded as something kind of negative, while in Asia it's something normal. You know, you now have this phenomenon with the gold beans in China, for example, where the younger Chinese population is buying physical gold in the form of those gold beans like crazy. So this huge divergence between the West and the East, that's really something important to understand, and therefore we really emphasize the topic. At some point, Western investors will wake up, but for example, Germany last year has seen massive outflows. Germany always used to be a stronghold of physical gold demand, and actually last year was a disaster in terms of gold demand. So it's kind of going the opposite direction.
Okay, so it sounds like from a Western standpoint, the momentum is still, we don't care, it's heading to the east, and that's fine, let them take it. I guess my question is do you see a point where that shifts, right? And again, you have your three different sort of pillars there: the private individual, institutions, and the government. And I would think, this is just me being a regular guy, I would think that Wall Street maybe might wake up first because it likes to make money. And if it sees, like I said, an asset is making money, it's gonna want to get in on that. And I would think, maybe let's start there.
Mm-hmm.
I would think that if that were to happen, the gold market isn't that big of a market, you know, certainly relative to the stock market at large or the bond market. So even a little bit of money coming from those markets into gold should have I think, a pretty big impact on price. And then, of course, if we want to talk about the mining shares, we want to talk about silver, you know, those markets are very small compared even to the gold market. So I guess now that we are in a bull market, we've had this big breakout, we now have the momentum. Do you expect Wall Street to increasingly wake up to this over, say, the next 12 months? Or do you think, no, it's just going to kind of remain asleep?
Well, you know, Adam, I worked in a bank for quite a while before we set up our own company, and I have to say that banks don't like selling or you know, promoting gold because they don't make too much money on that. You know, the clients buy physical gold, and what can you charge? There's no management fee, there's no performance fee, there's nothing. It's just it's out of the system. So I think this will probably go hand in hand with weakness in equity markets and perhaps private equity and stuff like that. So at some point, I think it might happen. But as long as the equity markets and especially tech and, you know, at some point, I think that the stock market in general is just all over Nvidia and nothing else that counts. Yeah, somebody said it's Nvidia is Taylor Swift for guys. It's it's just as long as the tech bull market continues, I think that that Wall Street will continue to kind of avoid talking too much about gold, probably. Yeah, we've got a couple of screenshots based on Bloomberg, the CPF function, which shows commodity price forecasts, and it shows that actually all the big banks they couldn't care less about gold, so they are forecasting that gold will, rise a little bit, and then next year and the year after will go back significantly lower. So that tells me, well, I think gold will continue to be something like that that Wall Street wants to avoid, actually. Let's put it that way. While I think private individuals, it is all about trust, and it's no coincidence that our report is called "In Gold We Trust." And we've seen with all those various crises, with the COVID crisis, and then obviously when it comes to politics, we're seeing that people have kind of lost confidence into the system, be it the political system, be it our economic system, and many other things like science and so on. So I think that many private individuals kind of get gold. They understand that it's an active decision to leave the fiat money world. But then on the other hand, that's definitely still a minority. And I always see a huge discrepancy between, let's say, the gold attitude over here in let's say, German-speaking Europe compared to the United States. And I think the main reason for that is that in our monetary DNA, gold is something really important. So for example, I got for like every bigger event, like big birthdays and Christmas and so on, I always got like little gold coins from my grandmother, because she lived through the Second World War, because she lived through 4 or 5 currency reforms, and usually people lose quite a lot when there's a new currency being introduced. And that's, I think, one of the main reasons why gold in the United States still isn't something that is, let's say, extremely popular compared to German-speaking Europe, for example. I think the US is still, in the monetary DNA, there's still the deflation and the Great Depression. That's actually what's more important.
Okay, so you talked about people losing faith on a lot of dimensions in today's society. Totally true. I think in the West and in the US, I agree with you. I think on average, you're right. People still think in terms of dollars, as the safe haven. But people are beginning to lose faith in the purchasing power of their dollars because of all the inflation that we've suffered over the past couple of years. Not enough to maybe turn the tide in terms of the average guy's view of gold, but it's waking more people up to this than we had before, right? And maybe that's a little part of what's going on here in the private demand in the West, like the people going to Costco and buying these gold bars, right? So what I hear you saying is if you're buying gold and you are or let me put it this way, most people are buying gold for the store value part of it, right? Like, I want to put my money in something that's not going to get inflated away, just like your grandma would give you those coins. That's why she wanted to do it. Sounds like that mindset much more widespread outside of the West, and that the vast majority of the buying that is creating this bull market is coming from China, India, Dubai, et cetera. So the people in the West, and most people who watch these videos of mine are from the West, who are buying gold for this. They're kind of in a minority in the West, but they're riding the efforts of the majority in the East or the emerging markets. Is that a decent way to say it?
Yes, it is.
Okay. All right. So if you're hoping that in addition to being a store of value, that you think gold could also appreciate in price and perhaps even increase purchasing power relative to certain other assets, Um, where do you think that demand is going to come from? Is it going to come from more individuals and more private demand, finally waking up in the West after a certain period of time? Is it going to come from the government side? We haven't really touched that yet, but central banks have been buying gold at record amounts of late. What turns this bull market into overdrive, if you think there's an overdrive gear still left ahead of us for the bull market?
Yeah, I think where could further momentum come from? First of all, I would not be surprised if we're gonna take a breather over the next couple of weeks or even month. We're entering a pretty weak seasonal period for gold. We're already seeing in India, which is a very price sensitive market, that they're actually selling gold and buying silver instead. They also have, their elections at the moment, which is also, from a seasonal perspective, a pretty negative environment for gold demand in India. And then I think, we shouldn't forget, Adam, that the price of gold was trading at roughly 1,800 end of October last year.
Mm-hmm.
So now we're above 2,400. So a $600 move. That's quite spectacular. And perhaps, I'm an avid runner. If you run up a hill, and if you're going too fast, sometimes you have to, slow down a bit, and take a breather. And I think that would be somewhat healthy for the gold market. Now going forward, we've got coming back to the title of this year's In Gold We Trust report, it's a new Gold Playbook, where we show a couple of charts that basically suggest that something has changed in the gold world. And one of those big changes is actually that we've traditionally seen a very strong correlation between the price of gold and ETF flows. So usually when the price of gold goes up, we're seeing inflows into the ETFs. And from my point of view, those are Western financial investors.
Mm-hmm.
If I run a fund, I don't buy, I'm not allowed actually to buy physical gold, because it's too risky. It's no joke. But ETFs are basically the preferred vehicle to have your gold position in a fund. But over basically since the year 2022, we've seen outflows from the ETF. So actually, the Western financial investor couldn't care less about gold. It might change at some point. I think that with silver confirming the breakout and also quite decent volume in the mining space, it seems that there's really something has changed, and we're definitely in a new stage of the bull market. And I think that Western financial investors, for example, ETFs, will become a driver going forward. Then, obviously, since the year 2022, something has changed when it comes to central bank demand. It has never been a really important driver, but now we are seeing on average quarterly purchases of more than 250 tons from central banks. First quarter of 2024, I think 290 tons of central bank demand. So actually, my take is that central banks have put in a floor. They're usually not very price sensitive buyers. So central bank demand is really an important driver. And that's also obviously only from emerging markets. China bought gold 18 months in a row now. We've seen Turkey buying, but we've also seen some European countries, for example, like Poland, like Hungary, Czech Republic, and also Singapore buying gold. So it's not only developing and emerging market countries. It is getting somewhat broader. I don't think that the ECB or the US at some point will announce that they are buying physical gold. I think that would be, that would be a sign that actually the market would kind of lose trust actually in the euro and the US dollar.
Because you think it would be an admission that we're
Yes.
devaluing our fiat currencies?
Yes, yes, absolutely, absolutely. And they already have huge amounts of gold. You know, in the euro system, we hold more than 11,000 tons of gold. The US has 8,100 tons, and we make some sort of a comparison between, you know, the time after the Bretton Woods Agreement, where we've seen, especially in the 1960s, this gold drain, where countries with large trade surpluses, especially Germany and France, actually took enormous amounts of gold from the United States. And we know, like, you know, Charles de Gaulle sent even the battleships over to New York to get the gold home to Paris. And now we're seeing not a gold drain, but rather, you know, some sort of a gold gain in emerging markets. And I think for those central banks, it's also a sign of, it's a gesture, it's a sign of strength. They do have significantly lower gold allocations in their central bank portfolios. They traditionally have a large US dollar and especially a treasury exposure. And therefore, I think that they want to come up to, I don't know, let's say 10, 12%, something like that. And I thought it was fascinating that the World Bank came out with a report a couple of weeks ago, where they suggested that actually, you know, the higher your duration risk is, the higher your gold allocation obviously should be. And they came up with a suggestion of up to 22% central bank gold allocation, which I found quite staggering. And we're still far away from that. So I think that Western financial investors, but also central bank demand, will continue to be very, very important drivers.
Okay. I'm just curious, did you do any napkin math? If we got to 20%, 22% central bank gold allocation, what that would do to the price of gold?
It would be significantly higher, obviously.
So let me ask you this. This might be an overly naive question, but like, why are these central banks buying gold? Is it because they have to, because investors are demanding you know, some sort of backing for the duration of the bonds that they offer? Is it optics, just to say, hey, look, buy my debt because I've got more gold? Is it to show strength in their own currencies that they issue? Like, what is driving them to say, you know what, we should buy more of this stuff?
Well, I think it's some sort of the weaponization of money. That's what actually is going on. And you know, as I've said before, you know, before the Ukraine war, it was, I think, 100 or 180 tons of gold that were bought by central banks, and now we're roughly at 280, 290 tons quarterly gold purchases, because the whole world actually realized, okay, with the stroke of a pen, the US dollar and the euro reserves of Russia can be basically wiped out. So what do you want to hold as a central bank, as a reserve asset? You want to hold something that is liquid, that is traded 24/7, that has low bid-ask spreads, that doesn't have any counterparty risks, that doesn't really have any currency risks, and something that is really accepted all over the globe. So do you want to hold the euro? Not so sure. The Japanese yen, Bitcoin, I don't know. So I think it's pretty obvious that for them the first choice is being diversifying their dollar exposure into gold.
Okay, so sorry to interrupt, but
yeah.
it's basically a swap then. You're saying, wow, okay, US sort of weaponized the financial system against Russia. Maybe someday I'm going to be on the bad side of the US too. So as a risk management tool, I'm going to start swapping out these treasuries that I have for something else that can fit their place. And gold seems to be a great candidate.
Of course, of course. I mean, you know, after Vladimir Putin was now re-elected, where was his first trip going to? China. And just have a look at the, you know, the images that were shown. And you know, Xi Jinping actually, it was kind of awkward, but hugging Vladimir Putin. This clearly shows that, you know, we're seeing some sort of a bipolar or like a polarization of the world nowadays. And I think the BRICS are, they're one big part of this story. And, with 4 new members now joining, while Argentina, they were accepted, but they're saying they going the kind of the dollarization
Yep.
direction.
They want to
And
be
then
on Team West. Yeah.
exactly. And then Saudi Arabia, which was officially accepted, but so far they haven't made a decision, because obviously, that would be a biggie. And we remember the first trip of when Donald Trump was elected, he went to Saudi Arabia. So the geopolitical significance of Saudi Arabia joining the BRICS cannot be underestimated. Now, the BRICS, I think sometimes it's people, let's put it that way. If you read the summary or the communique of the last BRICS summit, it was all kind of vague, and we intend to do this and that and so on. But it's pretty obvious that trying to come up with an alternative to our current system is something really crucial for those nations. And it's a little bit perhaps like the big brother and the small brother, where the big brother sees that the small brother is growing up and he's getting stronger and stronger, but he still is kind of the bully. And he doesn't really respect the small brother, but the small brother kind of realizes that he's getting stronger and more powerful, and that he actually has kind of a chance against the big brother now. So I think, if you just have a look at where the growth is, where the favorable demographics are, except for China, obviously, if you see where the innovation is, where the savings ratios are significantly higher, where debt levels are significantly lower, except for China again, then it's obviously that it's in emerging markets,
Right.
and those
where
countries.
the demographics are favorable too.
Exactly. Yeah. So therefore, I think it's, we've got one fascinating discussion between my dear friends Louis Vicent Gav and Brent Johnson in the report, where they discuss actually, the dollarization camp versus the de-dollarization camp. And Brent Johnson, obviously, Mr. Milkshake, he's in the strong dollar camp, while Louis Gav, being based in Hong Kong, is in the de-dollarization camp. And it's a fascinating discussion with so many things to consider. But actually, this process is clearly picking up momentum. Is gold like the center of this whole story? No, I think it's not. But it's a part of this story, because not only the central bank demand, but also the private demand and the gold production is primarily from those countries that are kind of lining up now and that see, okay, we're the small brother growing up, and we're actually more powerful these days.
So super interesting, and I'm sure we could do the whole episode just about the de-dollarization and the rise of the BRICS and all that stuff. Your analogy of the older brother and younger brother really hits home for me, because I was the younger brother, and growing up, my older brother was 4 years older than me, and so he always had 4 years worth of growth on his side. And when we got into a fight, I knew who was winning it. But what I realized as I began growing, and I'm now taller than my brother, and I'm convinced that was just through sheer force of will, is I began realizing I didn't have to win the fight, and I knew I wasn't going to. I just got better at making the fight more and more painful for him, right? So that became a pretty big deterrent, where he'd say, could see him think, he's like, I'm going to win it if we fight, but I'm not going to leave unscathed. Maybe I'll just avoid getting it to that level of escalation, right? So that may be the strategy of this rising. Michael Every likes to say it's the West versus the rest, right? So this rest cohort. Where gold can potentially play a very interesting role here. We've heard the speculation that the BRICS are working on their own currency, and it's going to be denominated in gold grams and all that stuff. Like you said, who really knows at this point in time? But there's a lot of players on Team Rest who, they've got a long history of not getting along, right? And so when you have players that don't have a long history of mutual trust, you have to have something in there that they all trust and agree on to be the glue. And gold may play that role, right? If they all agree that, hey, look, gold is the thing that we all agree has real value, and that's going to serve the basis of our trading block, or if we come up with a joint currency, we can all agree that gold, could be a backbone of it. I'm not saying it for sure is, but I can see it playing that role. What are your thoughts?
I think so too, but I think what unites them is having one enemy, yeah, that can glue countries that are not best friends, like especially China and India, obviously, yeah, that can kind of glue them together. But as I've said, I asked Brent Johnson for Louis and Gaff, for example. Do you think that Xi Jinping cares about gold? That he's actually that he really cares about the price of gold? That he's watching the gold price? And he said, no, it's just a means to get from A to B.
Mm-hmm.
It is something that where I always come up with that quote because it's fascinating. People say that People Bank of China only has like 4.2% gold. But then actually Chinese private individuals, those are estimates, and from our point of view, that's somewhat accurate. They hold probably 20,000 tons of gold.
Wow.
And also India, just Indian housewives hold more gold than the United States. So roughly 10,000 tons of gold, just Indian housewives. So
and it's largely
just to
the form
put
of
it
jewelry,
into
right?
Exactly. But jewelry is being regarded as financial insurance, kind of.
Yes.
Yeah. So
yeah, a lot of that is to be passed through the family. It's more a store of value, right?
Exactly.
It's a personal bank. Yeah.
But there was a Chinese official who once said, because he was asked why the People's Bank of China holds so little gold, and he said, China owns gold through its people.
Mm-hmm.
So, at some point, perhaps they will say, well, we've got a major crisis. Please hand in all the gold that you own. And then China might up with, I don't know, 30,000 tons of gold, whatever. And if you follow, for example, what happened in China during the COVID crisis, I mean, those were real lockdowns. I've got friends that were in Beijing and in Shanghai during COVID, and they say, compared to what we experienced in the Western world, that's like nothing. So and people, they were following the rules, yeah. So China owns gold through its people. So perhaps at some point they will say, okay, you're getting so much renminbi for your gold. You have to hand it in, otherwise you're going to jail, whatever. And then China might end up with significantly more gold. That all sounds a little bit, like a big story. But I think it could happen at some point. So what I always said, if you want to play poker with the big guys, if you want to play like high stakes poker, you have to bring chips to the table, and those chips are golden. And therefore, I think it's no coincidence that the US holds more than 8,000 tons of gold. Europe altogether roughly 12,000 tons of gold. The IMF holds 3,000 tons of gold. Russia has been buying significantly. China owns significant amounts of gold. Turkey has been buying. So many of the really important players, they already have lots of gold. And I always said at some point we will see, let's say, a reorganization of our monetary system. Let's put it that way. And if you study history, you'll see that it happens every couple of decades. And I think this is really what counts for me much more than daily fluctuations. I think at some point there will be a revaluation of gold, and I think many important players are kind of they're kind of preparing for that moment.
Okay, so this is where the puck's headed. This is why we slogged through the 400 pages of your report, because you think that there is this transformative event for gold at some point in the future. So explain more about what's going to drive that. Is that because the world fiat currencies just continue their decline in purchasing power? I mean, it just, no matter which fiat currency you pick, basically, they're all headed downwards. That downward trajectory has accelerated over the past couple of years, at least, with the inflation that's been unleashed around the world. Is it just because of that? Is it because maybe a new bloc, Team Rest, whatever, decides that they can gain power by launching a better currency? What is driving us to this new regime change?
I think, Adam, that a Western financial investor, again, in the East, it's a completely different story. We are so heavily influenced, especially on the asset management side, by the Great Moderation. Basically, 4 decades of falling inflation, of rising bond prices, of very low macro volatility. So actually, for structuring a portfolio, inflation was the least concern. Then, obviously, we had the transitory inflation that wasn't really forecasted by our beloved central bankers. And now everybody thinks, okay, inflation is under control. Central banks did a tremendous job, and now it's like it used to be soft landing. Now it's never session. That's like the big buzzword. Goldilocks, whatever. I'm just somewhat cautious, I would say. I think that if you have a look at inflation numbers, they are sticky. It seems that some are picking up momentum again. We've been covering a couple of studies, actually, one by the IMF, that analyzes historical inflation episodes, and it says it takes a while. So the IMF has warned central banks to start lowering interest rates too early. And I think that inflation also is something very psychological. I just can say over here in Europe, everybody kind of thinks that their salaries will continue to rise by 6 or 7% every year. So we are seeing this wage price spiral clearly. Everybody is kind of used to this new inflationary paradigm. While financial markets, if you have a look at break evens, for example, if you have a tips, basically everybody is expecting that we're going back to the old regime, back to the Great Moderation. Everything's going to be fine. 60-40 portfolio is going to work. Well, actually, I think that if another inflation wave should start, a little bit like in the 1970s, then this, what we call the debondization, or anything but bonds, ABB, I think Bank of America called it that way. I think that's going to happen, and I think that's the point when many asset allocators will really start panicking, because we already saw tremendous drawdowns in the bond space. The 30 years are down from the all-time highs. What is it? 35%. The Austrian century bond, actually, from the all-time highs, is down 70%. So this is like the drawdowns that you usually see, I don't know, in the crypto space.
Right.
But many people don't realize it, because they think it's hold to maturity, and so on. So I think that this move that we're seeing in not only in gold, Adam, but also in copper, for example, in some agricultural commodities, also in equity markets, and also in Bitcoin, for example, is a clear sign of some sort of a cracker boom development. People are losing faith in in paper values, especially in bonds. People kind of start realizing that it's more about the real performance, not only about a nominal performance. And history just showed us that gold is a pretty reliable fiat hedge and a pretty reliable inflation hedge. So I think that could really be the trigger going forward. At some point, the Federal Reserve really having, how do you say, being painted into a corner. They want to lower rates, but then on the other hand, because we've seen in the first quarter that was significantly weaker than expected. But then on the other hand, inflation being quite sticky. So that's kind of already a stagflationary environment. And for the Federal Reserve, for Jay Powell, that's like a nightmare.
Yeah. And I think he's going to live to regret these words, but in his last press conference, he said, I don't see the stag and I don't see the inflation.
Yeah.
I'm not sure he's looking where everybody else is. Okay, so one of the conclusions of your report is you say we are convinced that it's advisable to consider increasing the percentage of both safe haven gold and performance gold in portfolios. I think you've probably just given a lot of the case for why you believe that. In regards to this combination of, hey, it's good to have gold as a safe haven, good to have gold in performance as a performance asset as well, because you think this repricing is going to happen and all that. So if those better days for gold are ahead of us, you're in Liechtenstein. I think you get the U.S. baseball analogy of we have 9 innings in a baseball game. Kind of what inning would you put us in right now in terms of this current bull market for gold?
Oh, that's a tough one. There are 9 innings, right?
Yep.
So, I did quite a lot of technical analysis, and based on Charles Dow, he once said, and he's like the godfather of technical analysis, and he said they're like in every bull market there are 3 different stages. The first one is the accumulation phase, where the price is going down or sideways, where sentiment is really negative, and where only like die-hard contrarians start buying. So this is the moment when you go to a cocktail party and say, I'm buying this and that, people will start ridiculing you. Mm-hmm. Then the second stage is the public participation phase, which is the broadest and the longest phase, which is, the media is picking up on a topic, there are new investment products, the big banks, they raise their forecasts, and it's just going steadily upwards with small corrections, but they are being bought because there's lots of money on the sidelines. And then there's obviously the distribution phase, where those contrarian players that started very early, they start selling, where everybody goes nuts, where you see crazy market forecasts and analysts rising their price targets to ridiculous levels. New products, everything is using huge amounts of leverage. So that's like the third stage. I would say we're like somewhere in the beginning, or let's say the middle of this accumulation phase. So actually, breaking out from this massive resistance zone, out of this, cup and handle formation, that's clearly the sign, okay, something has changed in this bull market. And as I've said before, silver now starts outperforming gold. The mining stocks, we're seeing some significant volume. We're seeing some M&A kicking in. So I would say, let's say first half or first third of this public participation phase. So in baseball terms, that would be like the third or the fourth inning, something like that. But obviously, Adam, it goes hand in hand with the macro world. As I've said before, if the Federal Reserve should hit the panic button at some point, then I think the market will realize that the emperor has no clothes, and all those narratives like never session and back to the great moderation, Goldilocks, they will be priced out, and this could really be the point in time when gold and especially silver and the mining stocks really go crazy. We haven't talked about the debt situation yet. There's a big chapter about what's going on in terms of basically. So one of our takes is we've always seen solvency crises, in emerging markets, and we had it in Europe with the Mediterranean countries. And from my point of view, it could actually be experienced in some industrialized countries, and Japan obviously would be one country where we're already seeing kind of the central bank end game. And just have a look at the price of gold in Japanese yen terms. I think it's up 27% year to date.
Wow.
And it was up big time the last couple of years as well. So I think that it is some sort of a pretty good setup for the price going forward. I don't see yet this irrational exuberance, and just one thing, and we're quoting Arthur Hayes, who's really big in the Bitcoin space, but he's writing a fantastic newsletter, and he says the last moments of life are the most expensive from a healthcare perspective.
Absolutely.
We are willing to spend infinite money on any treatment advertised to forestall the inevitable. Similarly, the elites in charge of Pax Americana are her vassals, and her vassals are willing to do whatever it takes to preserve the current world order because they have benefited the most from its existence. So I think that's really kind of what we're seeing now. The amounts are getting more and more ridiculous. The whole world thinks that in the US everything is different. I mean, of course, the US economy is doing well with a budget deficit of, what was it last year, 7 or 8% at full employment. That's like drinking 5 Red Bull and 6 espresso. Of course, I won't fall asleep, but that's not a healthy solution to being tired and to needing actually some sleep. So therefore, to sum up, I feel super comfortable holding gold as always. But it's important, Adam. Gold is not the solution to all our problems. It's not something that will hedge like everything, and therefore I think it's also important to differentiate between, let's say, this safe haven gold that we describe in the portfolio. This is physically held. This is stored outside of your country or stored outside of the banking system. Adam, you probably you cannot believe how many people approach me and say, "Where should I store my gold? In which country?" Be it New Zealand, Switzerland, Liechtenstein, whatever. That has really become a big topic. And those requests or inquiries are coming from very, very sophisticated names and organizations. So really geographical risk is becoming much more of a topic compared to the past. So, but this is the safe haven gold, yeah, where you shouldn't care about daily fluctuations. And then what's also important, but this really has to be actively timed, is what we call performance gold. This can be silver. This could also be mining stocks, but also to some degree commodities and perhaps also Bitcoin. But I think it's really important to make this big differentiation about the motive and also the volatility of those two buckets.
Okay, fantastic. And you mentioned the word I was realizing I was going to have to get to before we wrap this up, which was Bitcoin. How do you look at sort of the two camps, gold versus Bitcoin? Do you see them as sort of ideologically in conflict? Do you see them ideologically of the same tribe, just taking different paths to the same goal? Do you think both deserve a role in a portfolio? Sounds like potentially. What are your thoughts?
Adam, gold is a very emotional topic. There's no gray area. You either love gold or you hate it. It's very, very emotional. Bitcoin, it's the same. Everybody thinks that he has to have an opinion on Bitcoin. If I talk about convertible bonds, people couldn't care less, yeah. But you know, they say I don't know it, but there's not this kind of emotion coming up when I'm talking about convertible bonds or whatever. But for gold and for Bitcoin, it's always a very, very emotional discussion. Now, we write about Bitcoin in Gold We Trust report for 7 years now, because we think it's a big monetary experiment that we are following very closely, not only as researchers, but also as investors. We do run 2 funds that actually combine gold and Bitcoin. One of those strategies, for example, is 75% physical gold, 25% Bitcoin, with an options overlay where we basically harvest the enormous volatility that Bitcoin has. And you know, Bitcoin has grown up. You know, now I think from a legal point of view with the ETFs in the United States, I think it was a sign for the whole world that Bitcoin has really grown up and entered the financial world. And therefore, I think Bitcoin is here to stay. I think that, you know, it's all about the stock to flow ratio. We started writing about stock to flow, I think in 2011 already, when people didn't know anything about the stock to flow ratio and why it's so important for a monetary good. And I think that whoever Satoshi Nakamoto was or is, he clearly understood gold. He clearly understood the Austrian School of Economics. He clearly understood the flaws of our monetary system. And therefore, I think, why not own gold and Bitcoin? But we got lots of hate from the gold community, but we also got lots of hate from the Bitcoin community, because they say, well, gold is just for the elder generation. But
okay, boomer, yeah.
yeah. But why not own both? And I always make the comparison, you know, when the internet came up and people started reading articles online and on their Kindle or iPad, whatever, everybody said that's the end of printed newspapers. I still really enjoy my physical newspaper. I still enjoy reading a proper book and not, you know, on the Kindle or on the iPad. Yeah. But I also like, you know, reading stuff online. It's like, you know, you can have in your garage, you can have like the solid, reliable and safe SUV. But you can also have your motorcycle, your Ducati motorbike, whatever. Why not own both? Yeah, one of them is probably a little bit more risky. It's fun. It's fast. You know, it's kind of cool. But you know, if it's icy on the road, if it starts raining, you probably want to sit in your comfortable SUV. But why not own both? And that's kind of our approach. And I think it's what I really like, just the last sentence, Adam. I love the fact that young kids, they start discussing money now. They start learning about the Austrian School of Economics. They hear, you know, Cantillon effect, all that stuff. They hear it for the first time. And I think there's very, very important discussions going on. And I know many, you know, hardcore Bitcoiners that at some point say, well, perhaps I should buy some physical gold. And at the last conference in Beaver Creek, for example, I met some you know guys from the gold space that said, well, actually, we've been diversifying our gains in the mining space into crypto and especially into Bitcoin. So I think it's kind of changing at the moment. We're still the minority, but I think there's a case to be made for both. And just one last thing, because we're quoting Lynn Alden in the report, and actually for the next 10 years, that's CBO forecasts. Yeah, so we will see deficits in the United States on a yearly basis between 2 to 2.5 trillion every year. Now, what's in contrast the amount of newly mined gold over the next 10 years at current prices? It's going to be worth 2.5 trillion. And what's the amount of Bitcoin over the next 10 years, there will exactly be 1,25,390,925 Bitcoins to be mined. At current prices, that's 62 billion. So I think you just want to have something. It's all about relative supply curves, relative scarcity. And therefore, obviously, you want to own gold in that environment. You want to own Bitcoin, and you probably won't do so well owning US treasuries.
All right, very well. So much more to say, but we're at the end of the hour. Ronnie, thank you. Thanks again for just the immense amount of work that you and your colleague put into creating this, like I said, over 400-page report. For folks that are interested in getting their hands on this report, it is free, correct? They can get it online?
Yes.
Where
yes.
should they go?
In goldwetrust.report. First of all, I have to say, Adam, it's not just my partner Mark and I writing the report. It's actually a team of 20 people, and it wouldn't be possible to put it out totally for free in German, in English, in a long version, more than 400 pages, and also in a compact version. We publish monthly chart books, the Gold Compass. We have lots of special publications about gold, and it wouldn't be possible without the support of our premium partners. So therefore, you don't have to register for anything. We won't spam you. You just can download all the stuff, also all the previous reports on our webpage, ingoldwetrust.report. We're pretty active on Twitter, IGWT report. And then, as I've said, I'm also pretty active on Twitter myself. It's Ron Stoeferle. And then we run a number of investment funds, and you can learn more about them on our webpage, incrementum.li.
Okay, so Ron, when I edit this, I will put up the links to all those on the screen. Folks, I'll have links in the description below this video too, so you can get there with one click. Let's just talk for a minute more about your website there, not the report, but for the actual fund management part that you do. So I know because you're based in Europe, there are certain investors that potentially could learn more about investing with you. And then there are others, I think probably US-based ones like myself, that regulatorily cannot. So who are the type of people, if they're interested, who could actually reach out to you about learning more about your fund?
Yeah, well, actually, due to legal reasons, every country on this globe is allowed to invest with us, but United States residents or citizens, unfortunately. But from a compliance point of view, it's just impossible to deal with US clients, unfortunately. But then we've got the majority of our clients is obviously from Europe, especially from German-speaking Europe. But we also have a couple of clients from Australia, from the UK, from Canada, obviously. So yeah, just have a look at our webpage, incrementum.li. You find all the information about our funds there, all of our other research, stuff about our wealth management department. Yeah, it's all there.
All right. Well, look, Ronnie, thanks for everything. Thanks for putting so much of that material out in the world for free. Really appreciate you coming on and sharing with us the key findings of this latest report. And really very much am honored that you chose Thoughtful Money to be the first platform that you interviewed once the new report was out. Thanks so much. Look forward to having you back on here again at any point in the future where you see something that's worthwhile, where if you think that we're shifting, from the middle of the accumulation phase into something more interesting, please come back on and tell us about it.
Thank you very much, Adam. Yeah, appreciate it. And just can say, keep up doing such a tremendous job. I really love watching your show. And I always learn something. You always put some sort of a smile on my face because I think it's just really good conversations, and therefore I'm very glad that you've invited me. So thank you very much.
Well, thank you. I totally do not deserve that, Ronnie, but you just made my day. Thanks so much, my friend. Take care.
Thank you. All the best.
All right. Well, now's the time on the program we bring in the lead partners from New Harbor Financial, one of the endorsed financial advisory firms. by Thoughtful Money. They will react to this discussion we just had with Ronnie, as well as give us anything they think we need to know about what's happening in the markets this week. I'm joined by Mike Preston this week. John Lodra has the week off. Actually, I think John's going to be gone for the next 2 weeks. Mike, great to see you, my friend. How you doing?
Hey, good to see you, Adam. Thanks for having me here again.
Hey, pleasure. Really fun to spend time with you last week down both in LA and in or Orange County and in the Palo Alto area when New Harburg was out here for its Northern and Southern California events last week. That was a great time. Met a lot of really great people there. I am excited to dig into your response to Ronnie here. One, because I know that gold is an asset that we talk a lot about on this channel with you and John. It's got a key place in the New Harbor portfolio. But Ronnie, emphasized a couple of things that you've been beating the drum on personally, Mike, for a long time. Specifically, the decade plus long cup and handle that was forming in gold, and that we did break out of that this year. That's something that you had been really telling people to watch very closely ever since we turned into 2024. That turned out to be correct. Ronnie thinks this breakout has legs. So very curious to hear, Mike, what were some of the highlights you took away from the conversation with Ronnie?
Yeah, thanks, Adam. And thanks again for mentioning the trip last week. It was a whirlwind. We had a great day in San Juan Capistrano, and then the next day, Friday, the 17th, up in Palo Alto, California. We hope to do it again with you, and we hope that your viewers will think about joining us next time. We met a lot of great people, met some clients that we already knew, and made some new relationships. We had a great day. We talked for 4 or 5 hours together, and it was a discussion, and it was a lot of the same topics that are on your program every week, every show. So thank you very much for that.
Yeah, and I should thank you guys too for pulling Jan Van Eck into the conversation. Great to talk with him. Really look forward to having him on the Thoughtful Money channel in the not too distant future. So that was a great connection.
Well, very good. We enjoyed it, and he did too. So, Ronnie, the talk with Ronnie was all about gold, and as you said, he with a team put together a report called "In Gold We Trust," 400 pages. Now, I'll be really impressed, Adam, if you read the whole thing. I can say that I didn't, but I listened very intently to this talk and enjoyed it very much. Ronnie talks about the fact that we've had a big breakout, or we're finally in a bull market in gold and in silver. And I can tell you personally that as soon as 3-4 weeks ago, I was talking to clients that were just frustrated with silver. Gold had broken out, and yet silver is still sitting there. I'm going to show a chart here. If you'd go ahead and enable chart sharing, I'm going to show that pretty soon. But Ronnie talked about this big breakout from...
I'll do it in just a sec, Mike. As you're doing it, I'm just going to pull up a chart here from the In Gold We Trust report, because it's speaking to exactly what you're talking about here, where you can see this long, 14-year cup formation, and then there's the handle, and then here's the breakout in gold. And then you can see here silver, very similar pattern. And right now Ronnie's got a question mark next to it, but I'll let you talk about the probability you see of this. But if silver follows the same progression as gold here, it should be up well into the high 30s, low 40s pretty soon.
It's interesting. Thanks for putting that up there. That's exactly what I was talking about there, that gold broke out of that cup and handle and silver didn't. Now, it didn't as of the date of that report. Since then, it actually has started to do that. And so I will put some of these charts up there in just a minute. But this base we've been talking about here for many months, in fact, probably a couple of years. This base is the largest, one of the largest I've ever seen, probably the largest I've ever seen. Here is a chart of gold. This just happens to be GLD, but using it as a proxy for gold on a monthly chart basis. The previous high in 2011 was not seen again until 2020, 9 long years. And then 4 long years sideways. I mean, it was really suffering. It was a suffering thing to be a gold bull during this time. This is a 40% bear market. And even though at these levels, gold had outperformed the stock market since the turn of the century, it felt very difficult to sit in here. But this 4-year sideways move was a triple top, and a lot of bears were saying, oh, this doesn't look good. It's a triple top, even look like a quadruple top. These things don't usually hold. And lo and behold, it broke out. So it broke out solidly above $2,000 an ounce, and that happened 3 months ago. So this has been going for a little bit. And puzzlingly, the mining shares have been underperforming, or at least they were. They're starting to catch up now. And silver was lagging. Let's take a quick look at silver, but it has now broken out too. And in its usual form, it started to outperform gold. Silver had a deeper pullback. It had a spike high back in 2011, and it had this giant triangle shape, which is also a basing pattern. Not as much of a cup and handle, a bullish triangle, I'd say. And it looked like it was never going to happen. But just really this month and last month, all of a sudden, boom, we went up on silver. And so I've got lines up here at different levels that I think are short-term targets. But on silver, and this happens to be the SLV, but it's all proportional to actual silver, we have had a confirmed breakout of a bullish triangle. And we should see roughly the same height here, which is, if you do the math, 27 minus 16, 11 points. We should add 11 points to this, the top of that triangle, which would be somewhere around 38, 36 to 38. Would be a target over time. But short term, I think we would see something in the low 30s on SLV. This corresponds roughly to the 32 to 35 range on silver. Spot silver is around 31 right now. I think that 32 to 35 is kind of the new normal. Gold is sitting right at 2,400. I expect it to hit our target of 2,500 relatively soon. It's only about $100 away. Gold is on a pullback today of about $30 an ounce, but that pullback is well expected. And I'd say that I'd expect a new range for gold to be 2,500 to 3,000. So that's kind of how we're looking at it. I'll stop sharing
do me a
this.
favor, head back to the silver chart just for a second.
Sure.
I want to make one comment on that, and then I'm also going to try to find one other chart here from Ronnie.
Give me 1 second to split back to it.
So
here it is on the monthly chart.
All right. So two things. First, I want to give you props because that wedge pattern there, on the bottom right that silver had been trading in right up until recently. You were telling us month after month that, hey, at some point silver is going to break. It's going to break up. It's going to break down. You were telling us you thought it was going to break up. It was just getting more and more compressed in there. Folks were really beginning, I think, to lose hope or interest, and then bang, as you had been telling folks, hey, get ready, it's going to make a move. It actually did. So first, I want to give you props there. Secondly, I want to note that silver, as you said, did cross $30 an ounce. I remember when silver broke below $30 an ounce, last broke below. So that was back in 2012.
Yeah, right here.
And it was, I think I've told part of the story in the past, which was I had the privilege of going to visit Richard Russell, who wrote was it Dow Theory Letter? Dow Theory Letters? It was one of the very first investing newsletters. I think he ended up writing it every day for something like 50 years. He's sort of a godfather of the investing newsletter business. And in his last year of life, I was invited to visit him literally on his sickbed. He was living in his house, but had in-home hospice care, and had a fascinating discussion with him. And this was down in San Diego. And so I invited Mike Maloney, who at the time was working out of Santa Monica, California. Those of you who are familiar with goldsilver.com and Mike, you know Mike. And it was a crazy trip. I'll summarize in more detail at some point in time in the future. But back when Teslas were very new, Mike drove me down to Richard's house in his new Tesla. And we had a phenomenal conversation with Richard. I actually recorded it. It's got horrible audio, but I have often thought about trying to pay an audio engineer to try to see if they can restore it. And if so, if there's enough interest, I'll make it available to folks watching this video. But anyways, the day after that, I was still in Santa Monica and went into the Gold Silver offices to meet with Mike, and woke up that morning, and that's when silver just had this, jaw-dropping, gut-wrenching drop from the 30s down into the 20s. And it really did feel like that whole, surge that we had enjoyed starting in late 2010 all through 2011 the back of that had been broken. And I remember asking Mike if he had seen the price of silver that morning, and he hadn't yet. And so, you know, I remember seeing his eyebrows kind of hit the ceiling as he looked at the silver chart. And I think we both felt in our guts that something material had just happened. But I will tell you, Mike, I had no clue that it was going to be, you know, a 10-year plus slog down here, you know, in the salt pits before silver actually poked itself back up above 30 again. So I'm very glad to see a 30 handle on silver once more.
Yeah, this was really frustrating. This is a big bear market, right? But the fundamentals support gold and silver. And it took a 4-year consolidation, both in gold and in silver, but it did break to the upside. I didn't know for sure, obviously, that it would break to the upside. I only saw this triangle, this bullish triangle. And of course, we've got the fundamentals at our back, I believe, with the runaway money printing, that type of thing, and what we think is the beginning of a commodities bull cycle. And the sentiment was really bad. Let me tell you, the sentiment was really bad. Even a couple months ago, people were saying, you know, I think I want to get out of my silver. I was advising them not to. But at this point, gold had taken off and like, well, gee, silver's a dog. It's never going to move. But then look at this boom. We, you know, on this asset, which is actually SLV, not spot silver, we're up about, you know, $9 on 21. It's almost 40% in a couple months. In my opinion, is it's not over yet. So Ronnie talked about the fact that we've had this big breakout, and he says that now the CTAs are jumping in, the Westerners are not in the trade yet, and so we're basically in the early innings, of this whole thing. If you make a baseball analogy, and actually he said we're maybe in the third inning. We're in the first phase, the accumulation phase, and only about halfway through that. And
yeah, and just to remind folks, so the accumulation phase is when the bull market starts, but it is more or less where the early money gets in. Then he talked about the mid phase, which is when, you know, traditional capital kind of wakes up and sees the momentum and says, hey, I want to get in this game. And then the last phase is the blow off top phase, which is when things can get really crazy. Each phase is not equal in terms of time duration, which is why I think Ronnie put us in the third or fourth inning. The crazy last phase generally doesn't tend to last as long as the other two. But I think the important thing to note there is, you know, hey, it's not too late to get into this bull market. Ronnie thinks, you know, it's not that far underway. And if it does end up going where he thinks it could go, the majority of the price action still lies ahead of us.
I would agree. I don't think it's too late to get in, Adam, at all. As Ronnie said, in the accumulation phase, you'll start to see silver outperform gold. We've started to see that in the last few weeks. Finally, the gold-silver ratio is going in the other direction, or the silver-gold ratio has gone from about 85 to 1 to 78 to 1. Miners should start to catch up. We're finally starting to see that. We think the quick and easy money is probably off the table, but this move is far from over, in our opinion. And you should even start to see some M&A activity. We haven't seen much, but it's starting. It's basically starting, and we're seeing some of that. And all of this is with the fundamental backdrop that's really bullish. Ronnie talked a lot about why are central banks buying gold? And 70% of all physical demand for gold is from emerging markets and Asian markets. Central banks are buying gold like crazy because of the weaponization of the US dollar. He talked about the dollarization versus the de-dollarization, the dollar milkshake theory versus the opposite. And, it basically is a debate, and nobody knows which way that's going to fall. But this is a fact because of the meeting in Johannesburg last year with the BRICS countries, and they're talking about a trading unit probably backed by gold, and the fact that the United States has weaponized the dollar, particularly with sanctions against Russia and that type of thing. Other countries have started to wake up and said, look, we need something we can rely on, some kind of unit that's not based on the dollar. So all of that is really, really bullish for gold. So lastly, just bringing it down to what does the individual investor do? We've just talked about silver going up into the 30s. Let me be clear. I think that silver will make an all-time high. Gold has already made an all-time high. Silver has a lot more work to do because that all-time high was around 50 back in 2011, but we're already 31 to 32 on spot silver. I think we trade in that 32 to 35 range, consolidate. and then eventually break higher and eventually break into a new high, just like gold. Silver should outperform gold going forward. Like I said, the easy, quick money's off the table, so don't go on leverage. Don't have your position size too big here, but our recommendations of 5 to 10% of your investable assets should be in bullion. This is what Ronnie said is safe haven gold. Safe haven gold is gold and silver that you've got your hands on. Could be in a safe deposit box or whatever. If you don't have 5 to 10%, think about dollar cost averaging in. We're a little extended, and even Ronnie said we could have a pullback here. I agree. Pullback can happen at any time and be healthy. Maybe it already started. Gold is down $30 today. But
And it
gold
obviously helps people that are adding into their positions. You buy at lower prices, so that's good.
absolutely. I mean, if you don't already have it, start buying here. If you do already have it, I don't think the top is in. It may have to consolidate a little bit here. I think gold is going above 2,500, and that new range will be 2,500 to 3,000. I think silver will be well into the 30s and eventually hit an all-time high. And I think miners have a lot of performance as well to make up. And I don't know that they're going to go all the way back to their high, but I do believe that they're going to outperform gold and silver going forward. Having said that, we've got a core position in gold miners, and we've added to our hedges. We have 75% of it now hedged with out of the money call options that can be adjusted. So that's mathematically, that's a partial hedge. We're hoping to move that up with gold. We might even go to 100% hedged if we get miners on a stem. But overall, I think the wind is at our backs. It's not going to be a straight line, and I wouldn't say that this, I wouldn't say that you have to run out of these trades. I think they're going to go on for a while. That's ultimately the point.
All right. And, sharp-eared listeners, maybe you didn't even have to have that sharp ears, probably noticed that I didn't get the chance to ask Ronnie if he had an actual price target on gold. Well, the answer is here in the reports. Let me just pull it up here. Here are their current projections. So their intermediate target for the end of this year, 2024 for gold, you'll see here is $2,665. And then they're projecting that out until 2030. So the following 4 years would get gold up to close to $5,000 an ounce, a little over 4,800 here on the chart. So obviously these are projections. No one knows exactly what's going to happen, but obviously we will be tracking this trajectory closely as the year continues here.
I think those targets are very feasible. And it says at the end of this year, 2665. That's very doable. It could happen even before then. We're basically only 200 and something dollars away. In terms of at the end of 2030, that target seems pretty feasible too. I hope we see it. If we see that or even better targets, then everything we talk about here should be good news to anybody investing at these levels. So hopefully it's true.
All right. Well, this one's been very gold focused. Anything going on in the New Harbor portfolio or your portfolio strategy meetings that you and John and the team at New Harbor are having outside of gold that you want to note for folks before we wrap things up here, Mike?
Well, the wind is really at the backs of the bulls here in the stock market. We had a 5% pullback in April in the market. We're at new highs now, both S&P and NASDAQ, and most viewers probably saw that we touched 40,000 on the Dow. Valuations are completely off the charts. The valuations are not sustainable long term, but short term, anything can happen. We've all lived through the longest bull market I think we've ever seen. You could say it started in 2018, so we're going on 16 years. It's probably even longer than that. This is probably the culmination of a 42-year bull market in my book. So this is huge, right?
Okay.
And so it doesn't end easy, right? So I think we go a little higher. NVIDIA earnings are tonight, and by the time this video comes out, the most important earnings report will be known by the market. The way the technicals look in the market, it looks like we're going to break higher. We're not betting on it. We're only about 40%, maybe low 40% exposed to equities. We just increased our hedge, 15% notional hedge on the S&P at 49.50. And we're paying for that insurance using some out of the money call options on other things like our position in the Russell 2000. So, if we got a melt up, we'll participate, not as much as the market. And nobody knows when the top is in. I don't think it's in yet. I think we get a pop the next few months, and then a really hard rollover. I expect a historic a historic bear market that will surprise us.
All right, well, we'll see. Over at my Twitter account, I feel like every day, in fact, every couple hours, it seems now, I'm finding an article that just continues to sort of make it clear that the lag effect is increasingly weighing, at least on the consumer spending side of the economy. So just this morning, Mike, we just saw Target shares get knocked down about 10% because they cited weaker purchasing on a struggling consumer. You add to that the bankruptcy of Red Lobster that was just declared, and the terrible results from places like Starbucks and Tyson Foods and some of the consumer-driven brands that we've been talking about. So it's going to be interesting to see how this all works out. Again, I'm sure they're doing everything they absolutely can to keep the economy as stimulated as possible while we get up to the elections here. Little TBD. I mean, I'm not entirely sure they're going to be successful at that, but if they are, a huge question is what's going to happen after the election when they realize they can't keep the extraordinary efforts going on. Do we have a pretty material correction post-election? Who knows? I think folks have heard my thesis that I think that's likely to happen no matter who wins in November, but time will tell. But I will say the cracks that we're seeing in the consumer spending side of the economy are getting wider right now, not narrower.
Agree. I just want to be clear here. I can't guarantee this will happen, but this market should lose 60 to 70% or more from its high. I think that's what's at stake here. Now, I think it's going a little higher near term, but the big picture for those that don't want to play around on the fringes here in the very late stage, I would just be really safe. Treasury bills, 5%, they still exist. The yield curve is still inverted. I think this market will go higher, might go as high as 6,000 on the S&P. I can't believe I'm saying it, but that's what the technicals look like to me. But when this top goes in, I think it's a top for a long, long time, maybe years. So you got to be careful. Talk to a trusted advisor, talk to us if you just want to chat. Happy to give you advice. And so there's a lot at stake, and there's a lot of risk to the downside when this thing finishes. And that's what we're playing in the end stage.
All right. I think you got a lot of folks' attention there with that 60% decline potential. I don't have enough time left here to really dig into that, but Mike, maybe we'll do more of that next week. I know that's based in data like that John Hussman puts together, so maybe we can pull up some of those charts next time.
Sure.
All right. But anyways, great session. Just wrapping things up, folks, if you enjoyed this conversation with Ronnie, I would like to see Ronnie come back on again at some point in the future when he's got an update on where precious metals are headed for new, fresh data. Please let us know by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. And if you look at the subscriber counter here on YouTube, you'll see that we've now passed 90,000. So we're zeroing in on the $100,000 mark. So if you're watching, and I know that there are 30, 40, 50,000 people watching this video. If you're watching and not yet subscribed, please do take a second and just hit that subscribe button to help us cross that goal. Also, if you would like to get some assistance in figuring out how to add precious metals to your portfolio if you don't already add them, or if you want to start increasing your exposure, given what Ronnie talked about here and what Mike talked about, highly recommend you do that under the guidance of a good professional financial advisor who can advise you on that. A lot of professional financial advisors don't want to tell you to get into gold because, especially if you're buying the bullion, they don't make any money directly off of that. And so they tend to discourage you from buying it. And oftentimes it doesn't even fit in their worldview anyways. And they kind of try to talk you out of it, kind of telling you that owning gold's a little crazy. In my opinion, those are red flags. But if you've got a good financial advisor who can help you do that, great, fantastic. But if you don't, or you'd like a second opinion from one who does, especially if you're thinking about getting into the mining shares, trying to play that upside, then highly recommend you schedule a consultation with one of the financial advisors endorsed by Thoughtful Money, perhaps Mike and John and the team there at New Harbor Financial. They're very experienced in investing in the mining stocks. They're very experienced, as Mike has said, in placing hedges against them too. It's a highly volatile asset class. And so being able to have extra risk management on that is just prudent. So anyways, if a consultation sounds interesting to you, then just go to thoughtfulmoney.com, schedule one there. Only takes you a couple of seconds to do so. Also, while you're at thoughtfulmoney.com as well, that's where you can sign up for our free newsletter. So be sure to hit that link at the top of the site menu and sign up if you haven't already. All right, Mike, thanks again for hanging with me for this week. I'll let you have the last word here as we say goodbye to folks.
I think we covered everything, Adam. Thanks for watching, everybody. Happy to talk to anybody anytime. You know how to reach us down in the bio. Adam's got a link. So thank you. Until next week. Thanks, Adam.
All right. Thanks, Mike. Everyone else, thanks so much for watching.